Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
And I think that's it, Steve.
Jake, unfortunately, you're going to have to take a couple of questions because I'm frozen, and if I get out, I won't be able to get back in. So even though you see me there, I'm hoping that everybody can hear me, but other than that, I can't even see the questions. So if you wouldn't mind a couple of the questions, and if there's anything that is related to ISE, I'll take them.
Okay, let me take a look here. First question, is liquidity simply caused by interest rates, or is it QE, quantitative easing, also? It's a little bit of both. The question means as the Fed, as any central bank lowers interest rates, you tend to see, it tends to create more liquidity. No doubt. But the quantitative easing is really the big kicker here. Quantitative easing means that the central bank monetizes the debt of the government through the Treasury. When the central bank starts buying the Treasury debt themselves in a very, very big way, that's a massive push in terms of money supply into the system, and has a direct and much more powerful impact on liquidity than even lowering than the power of the interest rate tool. Sometimes you can lower interest rates and it doesn't matter. It may not create liquidity. If people don't want to borrow and people don't lend, even with low interest rates, you're not going to create liquidity. Japan was in this situation. Japanese central bank, after the bubble broke in 1989, pushed interest rates to zero. And even though they pushed interest rates to zero, nobody showed up to borrow and nobody lent. So it's not all about interest rates, and that's why the quantitative easing is used now in a big way to force that liquidity into the system. Very good question and an important question. Thank you. It's a good question. What exactly is a currency crisis, and how would that occur to the U.S. dollar? Well, currency crisis is a situation in which, and you usually creates what I would call a triple whammy situation. The crisis in itself, meaning the dollar could start to fall, and all this negative sentiment that it could fall through its old lows, and all the negative sentiment continue to build, and maybe there's an idea in the background that Moody's is going to cut the AAA credit rating of the U.S. Treasury, that type of thing. Usually a currency crisis leads to, at least on a short-term basis, a massive move of assets out of a particular country into another hiding place or some asset class. A triple whammy, when we've seen currency crisis before, has usually impacted the stock market. The currency is the driver, and it's impacted the stock market and the bonds of the country, creating that triple whammy scenario, all going down at the same time. It's a very scary scenario. And when you get a dollar crisis or a currency crisis, and other countries experience this more than the U.S. have, obviously, when you get a currency crisis, what your central bank is forced to do is to hike interest rates in order to protect the currency. Sooner or later, the central bank has to come in and protect its currency, and that's which leads to higher interest rates. So if you think about interest rates being spiked higher at a time when the U.S. market is struggling to grow, it would actually damage the U.S. economy even more, but they would have to do it to save the currency. And that's why a currency crisis is so negative, not only short-term as the assets run out, but longer-term because of the impact of the central bank raising interest rates in order to defend the currency. Question here, when did the euro start? What website shows currency yields is an add-on question. The euro started in 1999, if I'm not mistaken, and came out, I think it came out around 120 or that range against the U.S. dollar, and quickly fell in value to around 84 cents against the U.S. dollar before the U.S. dollar bear market started in 2002. So the euro has gone from about 84 cents or a little less than that in 2002 all the way to 160, which was its high. So it doubled during this dollar bear market. So you can see the massive move the euro has made against the U.S. dollar. And it's very hard to say that the relative value in the Eurozone is twice what it is here based on the U.S. dollar. And that's why I say from a relative fundamental standpoint, doubling of the euro against the U.S. dollar, the euro is way overvalued here on a lot of different measures. Websites that show currency yields, you can go to the wallstreetjournal.com. Wall Street Journal provides that. Even if you go to bloomberg.com, another free site that provides that, financialtimes.com, and go to their capital markets page. You can also see that on some of the specific websites related to FX. They have that, so it should be available pretty easily. The easiest one to find probably for you would be bloomberg.com. Sometimes Wall Street or FX or Financial Times may be protected because it's a subscription site, but you should be able to find that on Bloomberg.com pretty easily. Next question, how low will the U.S. dollar fall? It seems that the Fed is more concerned with low than with a strong dollar. It's a great question. Number one, we don't know how far the U.S. dollar will fall. We're afraid that the U.S. dollar could go a lot lower if the U.S. administration continues these policies, and there's no saying how far it can fall then if the U.S. continues to lose wealth and lose jobs. The sad part is they think a lower U.S. dollar will help employment, but as I showed you, I don't think it will at all. I think it'll continue to chase capital out of the U.S., maybe short-term at the margin, but even though we've seen bounces in the U.S. in bear and bull markets, ultimately, if you look at the long-term trend of the U.S. dollar, even though it's been in its bull market rallies, it continues to make lower highs and lower lows, and that goes to a real structural long-term concern about the wealth in the U.S. Economy. And if we don't see a change on that side of the fence, I think you're going to continue to see manufacturing jobs move out. You continue to see less and less efficiency of the manufacturing plants that are in the U.S. So to me, it's a very wrong-headed scenario.
Hey, Jack, I have a question.
Yeah.
If you don't mind. How about savings? How has the savings rate been in the last month or two? Have we been saving more over the last, let's say, year?
We've been saving tremendously more. In the midst of this cycle, when all this credit was being created in there, I think savings rates slipped into negative territory for the average U.S. citizen. And the reason they did is because during that massive increase in credit before the credit crunch, we had a big spike in our housing prices. We had a big spike in the stock market, so everybody felt very, very wealthy. They didn't have to save. They had a lot of these assets that they thought were building their 401k. Credit crunch comes, and all of a sudden jobs start to go away. Everybody gets scared, and now the savings rate has spiked from 0 or even less than 0 up to about 6% of GDP, and it's rising, still rising. We think that could go back to 10% of GDP, which is kind of has been the average historically in that range in U.S. savings. People poo-poo that, but it is happening. And the reality is savings ultimately long-term create a pool of domestic capital for a country to draw on. It's exactly the type of domestic capital the U.S. needs and stop depending on global capital in order to fund themselves. So savings is increasing, and unfortunately, with the Keynesian-type economists in this world that think you can only grow by consumption, the reality is savings is what creates wealth for a country long-term. Near-term, when you're juiced on consumption, and the U.S. economy is being 70% of its GDP or over that is consumption, there's a negative hit to growth and to everybody. And this goes to what we started with a little bit I discussed earlier of the rebalancing going on. We need to rebalance and cut the amount of consumption in the U.S. Way down from that 70%. The Asian bloc needs to increase the amount of their consumption and reduce the amount of excess capacity. So this is that balancing that's taken place, and it's healthy for America, and unfortunately the policies in place by the administration are just the opposite to inducing savings.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.